Good morning, traders and investors. Roger Scott here, Senior Strategist for Wealth Press. Today's Thursday. It's June 15th. The month is halfway over, and boy, oh boy, the Fed has spoken yesterday, and guess what? The Nasdaq is opening down 105 points. That's definitely not random. Now, I hate to say I told you so, but boy, oh boy, I did, and we're going to get into more of details in this video. Now, before I get deep into it, make sure you like this video, subscribe to this channel, and if you're watching on YouTube, go to the YouTube Wealth Press channel. You can like this channel, subscribe to this channel, and post comments and feedback. If you want a little more details, go to rogerscott.com/Telegram. Sign up to my Telegram channel, and you'll get free picks, analysis. You'll be the first ones to get these videos and all the other goodies. Now, let's get into it right now. So as you can see here, the Dow's down only about 56 points, but after yesterday's announcement, and I don't know what people were expecting, what people were thinking. I guess people were thinking the techs were going to just go to the moon, but they're not. They're not. Today's Thursday. We've got a lot of data. It's about 7:58 in the morning. The market's going to gear up to open in about an hour and 32 minutes, to be specific with you. Now, on the implied volatility front, you've got Adobe coming out with earnings today, and you got Kroger coming out with earnings. Adobe's expecting 7.4% in its price in terms of volatility, and Kroger's expecting 5.8. Now, Adobe can definitely reach 7.4, but Kroger, unless it's like really, really nasty, I don't think 5.86% is going to be on the table. So I think Adobe will reach beyond 7.4 or something in that neighborhood, but Kroger won't. So if I was an option buyer, I would be buying Kroger, and if I was an option seller, I would probably not be doing anything because Adobe can't go above 7.4. I'd probably be leaving it alone. Now, I'll talk about more of this in my VIP room. Matter of fact, I want you guys to remind me to talk about this in my VIP room because I want to talk about Adobe and possibly putting on a trade before earnings comes out before the end of the day. Now, let's talk a little bit about what's on the table today. We've got jobless claims. The last time the number was 261. Now, just to give you guys some background, this number, the 4-week moving average or the typical ratio, we were like at 200, 220, 200, 220. Then we went up to 240. I said, well, it's still okay. But last time we went to 261. That's danger zone. And one of the factors that the Fed is using to keep rates low for the time being is the fact that we have very low jobless claims, that the employment data is going well. Well, today's report is going to be very interesting because if this number is above 261, and I'm not saying it will be, but let's say it's at 275 or 280 or 300, that's not going to reflect well. That's the first report that's coming out. That's coming out in exactly half an hour. The second report is coming out as retail sales. Now, typically, retail sales are very, very instrumental because they make up 2/3 of the economy. But I don't think they'll have as much of an impact unless the numbers are totally off because we already had the PPI, the CPI, and the Fed meeting. So we kind of have the trajectory, if you will, or the lay of the land. Excuse me. So I don't think the data is going to be that instrumental unless retail sales are down negative 0.5 or 6. I don't think it's going to make a big impact. So the bottom line is, as long as these numbers are somewhat in line, good or bad, we'll be okay. The next report is going to be industrial production, and that's happening about 45 minutes after the market opens. I'm looking for the capacity utilization rate, and I'm looking for manufacturing output and obviously industrial production. But I also don't think it'll have as much of an impact, but keep your eye on industrial stocks, or maybe don't go into industrial stocks till after the report comes out. We also have the Empire State Manufacturing Index. We also have business inventories, and we have the Philadelphia Manufacturing Index. That is going to be an important report. The latest number was negative 14, so there's going to be a lot of reports, and that's also coming out at 8:30. Fortunately, the majority of these reports are coming out an hour before the market opens, and even industrial production. So we should have a pretty good idea, if you keep your eye on the futures, of what we can expect. But don't expect a major rally from tech stocks. I think that ship is sailing, and I'll talk about that in a bit. Now, first of all, 2 days ago, I told you that the number of stocks making 20-day breakouts is getting above 400. Intraday, it was about 440, actually. And I said whenever you have large cap 20-day breakouts on over 450 stocks, 440 stocks, that's usually the beginning of the end. That's the first thing I told you a few days ago. So don't come telling me that you had no notice, you had no warning. I also showed you how information technology, the 200-day moving average, the 100-day moving average, the 50-day, look at this 50-day moving average, how it was all extremely overbought. Like, not just overbought, like crazy overbought. Look at this. Like the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times we've been there in 5 years overbought. And in 10 years, let's see, this goes back about 8 years. 1, 2, 3, 4, 5, 6, 7 times. 7 times in 10. So this is not a regular momentum level. That's the 50-day. That's the 50-day. The 20, look at this 20. And discretionary and communication services, they're doing exactly the same thing. So don't think it's just one sector. It's all of these 3 sectors. I mean, look at this. This is a 10-year telecommunication, which is also tech. It's got Google, Meta, and all those stocks in it. 1 time, 2 times, 3 times, 4 times, 5, 6, 7 times. So the momentum levels where we're at, and I warned you yesterday they were going to start moving up. Also, I warned you a few days ago, beginning of this week, that volatility might start moving up. And I do believe that volatility, I even drew this channel, I think it's in the lower end of the range. I think volatility is going to start rallying as well. Now, let's talk a little bit about what we can expect today, what happened yesterday, and where we could take it from here. Because remember, today's Thursday. And on Thursday, Uncle Roger gives you the best ETF and option pick. And it's not going to be telecommunication, it's not going to be tech, and it's not going to be energy. So I'll give you a clue right there. So 3 major U.S. benchmark indices finished the regular session mixed as hawkish signals from the Federal Reserve weighted on sentiment, while investors weighted retail data. That's coming out, as I said, at 8:30. Federal Reserve held its policy rate at 5.25, breaking 10 consecutive rate increases over 14 months. They've been hot and heavy. At the same time, the summary of economic projections released by the central bank revealed that most policymakers now expect the benchmark rate to reach 5.6, not 5.25, 5.6. Remember I said that a year ago? A year ago I said it was going to be about 5.6 by the end of 2023, up from a previous projection of 5.1, implying that at least 2 more quarter point hikes are in the cards. At least. I'm going to say that again. Mr. Jerome Squirrely Powell, don't get me started with him, stated that the central bank would consider the cumulative impact of hikes. Basically, they're going to sit and wait while making future decisions. They don't know what to do regarding whether or not to implement further rate increases. Basically, what he's saying is, let's see what impact what we've done will have on the economy before we go further. He is not saying they're going to stop. Matter of fact, they are not stopping. In addition, Powell conveyed a positive outlook on the battle against inflation, noting that multiple factors are showing progress. They are, but it's very, very slow and it's very, very sticky. And it's stickier than they expected. Regional bank stocks. Now, we've been short regional bank stocks, and I probably should have shorted an individual stock instead of the ETF itself, but here we are. They were weighted down by Xeon Bank, 5% drop, and more nasty bank news. Semiconductor stocks gained ground. Not today, they're not. With Intel and Nvidia climbing over 4%. I think we're going to see some downside there. Today, all eyes are on regional sales. Economists are expecting it. I don't really care what the month-to-month number is. I care about annual number. Retail sales, let's just take a look at what the annual number is. They don't have annual, so we can't really use annual numbers. Also, industrial production's coming out and initial jobless claims. And I told you, we got to watch the number. I'd really like to see the number below 250. Preferably way below 261. If it's above 261, that chip that Powell's been using, the employment is very, very steady. It's not. So let's see how it goes today. Europe is down just a bit. They're digesting the hawkish signals from the Federal Reserve while cautiously waiting monetary policy decision from the Federal Central Bank. Mining stocks are under pressure today after data show Chinese economy softening in May, and that's not good for anyone. China closed higher after central banks cut the borrowing cost of its medium-term policy loan. On Thursday, China industrial production, retail sale, fixed asset investments all grew at a slower than anticipated rate. They thought they were going to just jumpstart after COVID. It's not that easy, bolstering expectations that Beijing will ramp up stimulus measures to support the fragile economic recovery. That's hurting us in the U.S. as well. So the more stimulus they get there, the better it'll impact stocks that are driven by China, like gambling stocks, export, all of these type of stocks that China is a real big, very instrumental in the U.S. economy and global economy. And I think they're going to remind us of that inadvertently over the next couple of months, because the exports from China are going to become a lot more difficult, and they're going to need a lot less imports there. Data on Thursday showed that the country's exports, this is Japan, unexpectedly grew for the 27th consecutive month on robust car sales, while imports declined. Now, one thing about Japan, they're not as focused on their export-import. This new prime minister is focused on improving the underlying wealth of the country and their conditions. And I think he's going to start increasing rates very, very soon. My phone is ringing early in the morning. How dare they? Let me pause that so nobody calls me this early. Sorry about that. So their trade gap narrowing by 42% compared to the previous year. I'm actually expecting a lot from Japan, excuse me. I'm expecting a lot from Japan's new prime minister. I think he's a Harvard-trained economist. And he's not going to leave rates low for much longer. That's one of the reasons why Warren Buffett is starting to put so much money into Japan, because he knows that interest rates are going to go higher. Leonard Home came out with earnings yesterday, I believe it was yesterday. Yeah, they did. And they were better than expected, which means we could see more upside from the home builders. Domino's Pizza also rose 2%. I really like the stock a lot. I'll be watching it. This is one of the biggest gainers on Wall Street in the last 30 years, just so you know. So that's what's on today. And you got earnings on Adobe and Kroger. I believe they're coming out after the opening bell. Now, let's look at each individual sector. Now, don't tell me that this thing with technology fizzling out is something that you did not know about, or you didn't hear about, or it's news, because it's not. So in terms of consumer discretionary, in terms of communication sector, in terms of technology, I'm expecting downside. I'm not expecting a lot of downside. What I'm expecting upside from is consumer staples, a sector that we actually owned, and a sector that I thought would go up, because I thought the technology would go down a lot sooner than it has, and it hasn't. So at the expense of technology, consumer staples have been going down, but I think the technology party is behind us. I think it's over. If I was a betting man right now, I would be looking at the consumer staples, or maybe I would be looking at, let me show you, I would probably be looking at, honestly, consumer staples. I really like consumer staples right now. If you look at XLP, because it's a very defensive sector. And also, just to show you which way momentum's moving, just to show you something, watch this. Momentum is moving higher in the short term, not lower. Almost every one of these sectors, look, 87%, 65%. It's okay, but energy's been hasn't been responding as well to news as I like lately. Financials. Healthcare still looks good. Industrial is a little overbought. Information technology is overbought. Materials overbought. Real estate's overbought. You see how overbought these are? But consumer staples, and look at 50-day moving average. Look at where it is on the 50-day moving average. Still at the bottom. Look at where it is on the 200-day moving average. It just looks to me like we have more upside to go. Especially in the short term, because I think all of the money is going to be coming out of the technology stocks, the discretionary stocks, and going into consumer staples, because we now have facts from the Fed that they are in fact going to be raising rates. Now, the bond market yesterday rallied on this news. It's expected to go down, but I think this news is actually pretty positive for the bond market. I don't think it's negative. Especially for the long bond, I think that it's going to get a little bit of a reprieve over the next few sessions, because I think folks were expecting nastier news from the Fed. Now, if you're going to buy the XLP ETF, and I'm going to give you the option right now, I would go further out on these. I wouldn't go that close on this. I would go to the 36-day out. You got 36 days. Don't hold this for more than 16 days, 15, 16 days, about two weeks. And I would be buying the 73, maybe 73, 74, the 73, 74, right around here somewhere. You could see there's plenty of open interest. And if no soup in 2 weeks, roll it over to the next month. If you want, you can go a little closer. And but you're going to be, but the liquidity is just not that great. So I would probably go with the monthly, 36 days out. As I said, if give it 2 weeks. If nothing happens in 2 weeks, just liquidate it and get something else. The liquidity is good here. You could probably get it for about $1.40 or so. If you want, you can spread that against. Actually, don't spread it against anything. Just do the 73 on its own. Remember, we still have a lot of data today. As of right now, stocks are not, especially technology stocks, are just not looking all that great, and there's a good chance the market is going to sell off. If tech rallies on this news, I'll be very surprised. Now, folks, remember, keep an eye on volatility, on bonds, and XLP, defensive. Now, folks, the markets may be on a roll right now, but looking at the big picture, I can't think of a time in recent memory where it's been harder to get ahead financially, which is what we all want. We want to get ahead financially. Everyday folks are still dealing with inflation, and we could see more bank collapses. That's why I'm short KRE right now, which would be bad news for the stock market again. The Fed didn't raise rates Wednesday, but it was more hawkish than most folks would like, and we could see another rate hike in 6 weeks. Yes, 6 weeks. Also, bad news. More and more people are leveraging what I like to call capital injections. That's right, capital injections. And they are pushing stocks higher and fast. I'm talking about overnight. Imagine you get into a stock on Monday, you get out on Tuesday. You get into a stock on Tuesday, you get out on Wednesday. You're holding 24 hours, so your exposure is limited in the time you're in the market. You're in and out, but you're not day trading. You can have your cake and eat it too. Again, these capital injections can push stocks higher and faster overnight. You're only holding 24 hours, no day trading. And these injections are hitting stocks every single day of the week. You don't want to miss out on this. Click the link below and learn about how to take advantage of these big capital injections that can cause big moves. You don't want to miss out. It's all new. It's very cool. Follow the link below. Check it out. You can have your cake in the market and eat it too. Bye. Have a great day, and I'll talk to you later. Remember, questions, comments, feedback, support@marketgeeks.com, or post your question under the video so everybody could see it. It's in the YouTube Wealth Press channel. Comments and feedback are welcome. Bye.